Hello everyone, welcome back to the Quiet Trader series. This is playlist 2 and this is episode number 6. So with this episode, we're going to be talking about liquidity and PD arrays. So with that said, let us move very fast. So first we're going to see liquidity, then PD arrays just in a sec. So we're also going to have clean charts as examples. So explanation. Let us start with liquidity. So liquidity, in a short form, it is a money resting above highs and lows, right? We all know where we find highs and lows. Those are the things that we captured in episodes Ezidi Wagulu or Ezidi previous. Okay, with that said, price doesn't just move random. We talked this in episode 5. Price doesn't move random. It moves collecting orders. And what orders does it collect? Since we are not the institutions, we are not the interbanks, we use stop losses, and our stops are liquidity. So that is willing or unwilling money. That is stops, because every time you go into any position, you're going to use a stop loss, and that stop loss is going to be the money that is removed from your account. So that is liquidity. That's where we put our stops on the highs and the lows, and that is the liquidity. Okay, for examples here, examples of liquidity, we have old highs, old lows. That's liquidity. Relative equal highs and relative equal lows. That's also liquidity. Trend line touches. That's also a kind or example of liquidity. Then obvious retail breakout levels. That's also a kind or example of liquidity. Okay, let us have types of liquidity also. What types of liquidity we have? We have buy side liquidity, and that is relative equal highs or old highs. That is buy side liquidity. Then for the sell side liquidity, that is relative equal lows or old lows. So that is the types of liquidity that we have. We have two types of liquidity: buy side and sell side, just as you see them there. Okay, so here we have a chart. We want to see those types of liquidity. So on this type of chart, this is Nasdaq 100. So okay, when we look on here, we are having some, they are not equal. That's why we say relatively equal. All right, so that is buy side liquidity. Relative equal highs, that is buy side liquidity. A person who went short or who took a short position, they are putting their stop losses on these highs. So that is money, that is liquidity. So smart money is going to come back and take out that money, that liquidity, and those orders. Okay, because a stop loss is an order. Okay, so when you look on here with this chart, a person who took a long, where do you think they are going to put their stop losses? Just above that low. So price is engineering liquidity here, making relative equal lows, and that's what sell side liquidity, right? Stop losses are in here, and that is an order where smart money wants to come back to pick that. So we trade in a footprint of smart money. That's why this is our target. This is not support and resistance. No, this is not support. It is an objective. Okay, so with that said, let us also have another here. Okay, when you look on this chart, we are seeing some structure. Okay, when you look onto here, what do we have? Isn't this a swing low? Because it has two candles besides it, they are not lower than that low, right? That becomes a swing low. It is old low. That's sell side liquidity. Okay, when we look in here, price took out that old low, as we have been seeing that price takes sell side liquidity, and it does what? Because that is target, that's no support, it is an objective. See, we have an old high in here, right? Old high, that's buy side liquidity. After taking sell side liquidity, the price went where? To the buy side, right? As we have seen here, to the buy side liquidity. All right. So when I move forward there with the trend line touches, we have this, and that. So retail is seeing prices coming to this line, rallies, to this line, rallies. See what it was done. So these are old lows. Price is gonna come back to them, and that is liquidity. That's liquidity. Price is gonna, you see, all of these candles, we are all encapsulated zona bazibise with only few candles. All this movement with only few candles. You don't want to be trading this move. You want to be trading such moves. Okay. With that said, let us have also something in here. The same thing. Trend line touches. Price went back, taking them old highs, old highs, old highs. Okay. Now we are on PD arrays. It's gonna be a beginner-friendly explanation. It's not gonna be that much complex. So, with that said, PD arrays are special price areas where smart money reacts. Okay, they act like magnets and turning points. Like PD arrays would subira smart money okureactinga, but onto those arrays we have a way we find them and the way we call them. Okay, PD arrays, they are like special price areas. Okay, so what is PD array? First, PD stands for premium and discount. We shall call them premium and discount zones. Okay, so now in those zones is where we find the array. Okay, tutegere nti kiri PD tutegere PD kyekitegeeza, then arrays. In the PD arrays, in the premium and discount zone is where we find arrays. Okay, what arrays do we find there? How do we know that this is a premium or discount array? Okay, how do we find premium or discount? How do we use them? Okay, now here first we look onto the bullish structure in here. We're going to look onto the bullish structure in here and the bearish structure in here. Okay, first I'll answer the first question in here. Now in those zones is where you find PD arrays. PD arrays tugenda ziraba ku slide eddako. Arrays tugenda ziraba ku slide eddako. What arrays do we find there? Zerugenda okulaba in the next slide. Then how do we know that this is premium or discount? We use a tool called Fibonacci, right? We're also gonna see how that looks. Okay, then how do we know, how do we find premium or discount? Still, we'll use the Fibonacci to know that this is premium, this is discount. Okay, how do we use them? Still, we are gonna see that. Okay, now with the first thing, bullish structure. Okay, discount zone. We want to find the bullish structure. Let us say, for example, you're being bullish. Your anticipation is being bullish. You want to find your entries or arrays zineziri wano below the Fibonacci levels. Fibonacci tugenda okulaba. Okay, I also have a video. The link is gonna be in the description. You're gonna find the link of the Fibonacci. Okay, so the Fibonacci setting also zigenda kubanga jezidi different Fibonacci levels that I use, the OTE, the quadrant fib, the standard deviation. It's gonna be in the description. Okay, so with that said, that is for Fibonacci. But a fib, a measuring premium net discount, it is just a normal fib. Okay, you're measuring at a high and a low, then we get premium premium discount below 50% level and premium above 50% level of that particular dealing range. Okay, so when we are in a bullish structure or when we want to see price move higher tuba twagala to finding these arrays, the order blocks, which is a change in state of delivery, breaker block, mitigation blocks, rejection blocks, proportion blocks, volume imbalance, gaps, and fair value gaps. Okay, we want to find this in discount or at a level equal 50. All right. So the same with bearish structure. We are anticipating the market to move lower, right? We want to see these arrays in a premium zone above 50% level for us to be having a nice, good entry. Yes, the market is not going to always be like that, but we learn from one template. Later, we learn how to use other templates tutandika neno. But framework, a bearish market should give you an entry above 50% level. That's premium. That's where we want to sell. Below discount, that's where we want to buy. And these are the arrays: order blocks, breaker blocks, mitigation block, rejection blocks, proportion blocks, volume imbalance, and gaps, then the fair value gaps. These are the arrays that I know, but I don't use all of them. And I recommend the videos in the core content of Mr. ICT or Mr. Michael. He's the one who introduced them. So I also advise you to go if you want to get more details onto other arrays. But these are the arrays that are most common that we use. Okay. So with that said, let us just go through them, right? Because he's the one who introduced them. So I'm going to just break through them just to itembuish katon. Okay, so I will start with an order block or with order blocks. That's simply a change in state of delivery. When you see this abbreviation anywhere, CISD, that's the full. So that's just an order block. Like someone nakulaga this, that's an order block. Doesn't just a change in state of delivery. Okay, for example, let us say we have, as we all know that the market is not random, we have a level here. It could be an old low, it could be sell liquid, like any level for us to anticipate something to be bullish. First, you're gonna have a higher time frame narrative that's gonna make you think that the market is gonna move to the upside. You're not just going to the market and finding something like, and you wanna find something like this, then you wanna go long or you wanna buy. No, you need to understand the narrative and the bias. Okay, so with that said, okay, we see price coming, or it drops to a level. It can be a high time frame level, it can be any array, right? Sell side liquidity can be is like, for example, it's swept. Okay, to make it simple. Okay, the candle that traded there was swept that liquidity. Price near rallying. The moment this candle is encapsulated by an up closed candle, for example, I'm using a green candle here. Okay, that immediately becomes an order block after sweeping liquidity in here, right? But the most valued order block must be having a fair value gap in here, because you're gonna find other order blocks respected at the open, but when there is no fair value gap, or immediately at the close of this candle, the open of this candle returns to the order block. But the template or the basic template, etandika, an order block should be like this. It should have a fair value gap in here. That's really more valued. Okay. Big institutions wanna come back to enter more position in there. That's where we enter also, because they already entered in here. Okay. So this is a footprint left by them. That's why we call it an order block. Okay, that is a bullish order block. This candle that hit the array. Okay, an order block, its midpoint wakati wayo waitawo mean threshold, and we don't want to see price a candle close below that. Okay, if we are to be bullish, we can wick through, but it doesn't need to close. Okay, then we see price moving higher, but you must understand that the market isn't random. You're not gonna find something like this and you say you're gonna buy. No, you need to understand the narrative as to why price is doing what it is doing. So you're not gonna just understand that by a few back testing, but you're gonna do back and forward testing. You see it happening when you already did back testing, when it already happened. Okay, so then with the bearish, it is this candle, just the same, not to make this video long, just the same. Okay, that is the bearish order block, just the same logic. So let us move to the breaker block. So a breaker block, it is a structure. You see in a candle per candle, it is a structure. So to one low, high, lower low, higher high. So liquidity taken in here, that low has been taken, again the high taken. So that candle, any high, it becoming a bullish breaker block. You want to see price come touch that candle. Okay, then it rallies. Then the same here with the bearish breaker block. We have a high, a low, a higher high. Liquidity taken, that could be buy side. Lower low, swept in here, comes back. That low that created, that low that was broken to lower low, that becomes our bearish breaker. Okay. Mitigation blocks. A bullish mitigation block looks like this. It has a failure swing. We are going to look on the swing high in here. That could be a market structure shift, return to that bullish mitigation block there. Okay, a bearish mitigation block also has that short-term low or a swing low. Price drops after getting a failure swing. In a narrative bias that the market is going to be bearish, not just randomly finding something like this and you want to be bearish. No, okay, that won't work. Okay, so for rejection blocks here, rejection block ekolebwa wicks nga nyingi like this. Okay, wicks ziba nyingiko, that it is like back and forth market. But tuyinza okufuna candle, for example with this example gyenakoze ne striking nga nebeerako average trading okay, nemala ne komawo ne closing like this. Okay, so that candle, sorry, that wick, that longest wick gyetuita rejection block. Okay, now this is a bearish mitigation block, rejection block. Okay, and we call this wick or tusobola ogiyita candle kuba wakati waayo tuyitawo encroachment. Okay, encroachment, wakati wa candle bayitawo encroachment. So the longest wick ewabira wicks zino ennyingi gyetupikingamu, we want to watch that. So the midpoint, if respected, I see drop, market structure shift, fair value gap, return, and dropping, right? Anticipation, bias, bullish. Or in that particular range, that particular dealing range column, you're gonna be nimble about what you do, but it must be having a reason as to why it should move lower to the target you're aiming to, right? So that is for rejection block. So for proportion block, let us say we have a high time frame array in here. Price is moving higher and higher, reach to the encroachment of that 1 hour fair value gap, price drops. If you remember, high time frame array hit, okay, price drops, this candle has really encapsulated that candle. So the moment we're closing and a fair value gap, this becomes what? A change instead of delivery. So that is an order block, right? So price comes, this respects that fair value gap. Okay, the same candle or the same color, whatever color you cause, so long as it's the same color in here, it trades back into that candle or it trades back into that order block. That candle trading zeyo mid threshold yeyo order block, becoming a proportion block, right? Becoming a proportion block. That's the same candle has traded back to that order block, becoming a proportion block. So you want to see drop, market structure shift, fair value gap traded there. We're going to see price moving lower in the narrative that the market is going to be bearish. Okay, volume imbalance. Volume imbalance is just ziba weak nga zeyiseeko naye nga tewali gap. market opens nekola week, opens nekola week. That is a volume imbalance, right? Then for gap or void, wabira nga tewali kiriwo, just void gap. We are gonna see that in the charts. Okay. Then for the fair value gap, the mostly used one is a model 2022 fair value gap in here. Njita BC, buy side imbalance, sell side inefficiency. In Wajita CB, sell side imbalance, buy side inefficiency. So smart money is going to come back to that area to sell more. Smart money is going to come back to this area to buy more positions. Okay, so that is also a footmark or a footprint for big institutions or interbank. Okay, so those are the arrays. More details, ICT YouTube. Okay, now this is an OTE fib. Okay, this is an OTE fib. OTE sweet spot deep retracement. The midpoint of this dealing range from low to high, that is the dealing range. Tufuna dealing range atadeko Fibonacci from low to high, right? That's the dealing range. Now that's when we get premium and discount. Okay, so this is discount of this dealing range and this is premium. So this BC of fair value gap, it is in premium, right? It is in premium. This is in discount. So if you wanna be long or if you wanna be bullish, you wanna use this fair value gap down in here. For example, this wasn't a 1 hour time frame. By the way, this is Nasdaq 100. For example, tugamiti in chart tiyabadde ya 1 hour, because 1 hour is really high time frame. So if it is 1 minute, 3 minutes, you wanna find your entry at least down in here. At least you set your entry at this level. No what of day ko array here. Because OTE is also another model. Just again I'm right now. But it is there on ICT videos or YouTube. Okay. But this is discount, this is premium. So you wanna find a long below 50% level. Together. It will gonna bullish. Okay. Now when you look on here, we have a discount low there. Okay. It is sell side liquidity. It is an old low. Price did what? It dropped that low. So but I want us to mark this price. Okay. It is 24.66 okay. That is the price that we're having here. Because we're gonna use it. We wanna see how price returns to this level. Okay. Now, after price trading where to that low. Okay, it is what? It is discount. Okay, again to the premium, to the old high, and an old high is a what? Is buy side liquidity. Okay. So after trading that, after sweeping that low, sell side liquidity in discount of this dealing range, price went back to where? To the old low, and that is buy side liquidity. Okay. So with the same idea, we have a low and a high. We have got a dealing range, right? So this is premium, this is discount. Okay. So within this discount zone, because we are below 50% level, we have a discount fair value gap right there. Price trades there, went back to premium after getting back to where? To discount below 50% level. Okay. So if you were short in here or anywhere in here, this is a good objective, and it is an opposite array. That's also an objective. Okay. So went back to that buy side, you're gonna see it here, and took out that buy side. You're gonna see it here. So price really 21.8.7. Okay. We're gonna see that here. So when I zoom in here, we have Asia, London, and New York. New York took out Asian low in here it rallies to where? To that buy side liquidity. You had the 218.7, just like that. You know, so it came to discount to back to premium. Okay, so here's the most interesting part. I want us to mark the like eno low. I think fena tumanye eno low oba twagirabyeko the 669.1. That's the orange line. But now look on this look on to this low. Yeah, sweeping that 661.1. Okay, so njagala to continuing on waggulu one tulabe what happened. Okay, so when you look onto this gap and the price here 669.1 661.1 be a video one in right here make a gap can so nothing's added. Okay, kakano one in the price in one in. Okay, so price continued and it was any old highs, so price was making higher highs like tewali your old high into tugaminte gonna trading high reversing. In such conditions it's really hard for us to anticipate reversals, so tulina kusigala nga trading into that continuation. So any day market regular reversal, that's a lost day because you could be anticipating. Anyways, you can still find a structure bearish and you could be nimble about that, but I won't go there. Like you need more experience to be doing that. Okay, so it was making high highs. There wasn't any old high there. We could anticipate to see price dropping, taking out, then we could anticipate a reversal. Okay, so if you remember that low was 661.1 like yakola that low ginatadeko fib one eno to that high. Okay, on that high we got premium and discount. Okay, so price yavudde mu premium nejja mu discount, but mu discount we have something in here. You're gonna see that, but tusoke tutunye price eno ya purple eya 118.4.3. okay, so nakabawa 3 prices zemba marking. Okay, I want us to zoom in here. Okay, so when I zoom in here, that's where we got the high. That's the first dealing range tuina tunafuna kano ka dealing range akatono. Okay, so big dealing range, so utwafunye that price ya displacing utunulira wano tuina ka intermittent low, so kata short term low displaced back into a favorable gap. Market started to drop. Okay, so we could have this as a high that we anticipate not price to take out. Okay, that much fast. Okay, ngina taking a little bit longer kujibreaking because now trim premium market is kuseeking okwagala discount. Okay, so price nejange dropping. So when you look in here, we have a favorable gap also. Price traded in there dropping. So when I nyonyola institutional order flow in that video episode 5 na example jinakwese fanagana weight. Okay, so this came never took out that intermittent high. Okay, nezikula relative highs, it engineered liquidity. Okay, but for us we want to be bearish because we have discount arrays zili wano wansi. Okay, price ne displacing favor lookup, price trades there ne displacing. Now with this low created in here, when I put a fib from this high to this low, price never went back to the midpoint of that range. So that's where you could miss a move that price is gonna come back to premium to give you a short. Okay, but it traded back into this CBs there, then a dropping Nature into the discount of this big dealing range. This big dealing range from this low to that high. Okay, so that's where I took out this position. So that price, that old low in discount. Okay, we don't just randomly pick a low. In episode 5 I also talked about that picking a randomly to get a price, but we are looking into the zone. Now to get a price the general discount zone. Okay, now we come discount zone. You see that when we see that's got the dropping, it can still continue to drop, but we have to circle in a low. ne stopping entandika okola that bullish move. Okay, that's where that low we start anticipating that the market is gonna be bullish. Okay, so price ne rallying already mu discount, so ne rallying ne come into the favorable gap. When I put a fib from this low to that high, it's going to be equilibrium of that range. It's going to be at least equilibrium, midpoint of that range. And that is reasonable because it has also traded into a fair value gap in here. So that is reasonable for price to trade back into where? Into premium of what range? Of this low, of what dealing range? Of this high and this low. That is premium. You can see that on the fib. 50% level in here and the OTE is just there. Okay. You can see that price runs from premium to discount, from discount to premium, sweeping old highs, sweeping old lows, sweeping relative equal highs, sweeping relative equal lows. Okay, so when you took out that, it was in discount of what range? That big dealing range. Okay, it is in discount. So we got that small dealing range in here. It looks like a reversal, but it is just going back into, I would say, a short-term premium to send it lower to where? To these levels, 669.1, 669.1, 661.1. Those levels twalabye eri emabega. Okay, price engineered liquidity. Otunulira wano ebbanga liyiseewo like dene, tuyinza okuba tulina mu new month oba nga weeseewo like 2 months. That's the good thing of doing like analysis on higher time frame. You're gonna find like longevity of the bias job of frame is on a higher time frame, because the market takes long to break the structure again. Okay, so it came back to those lows again just here. Okay, so it engineered those lows, it came back for them. That was just a short-term premium after trading to a discount of that big dealing range back into the premium of this small dealing range. We are reversing it there to premium, selling it back to the old lows. Okay, with that said, this is how a volume imbalance looks, just like that. This is a fair value gap. It is a CB, sell side imbalance, buy side inefficiency. And this is a BC, buy side imbalance, sell side inefficiency. It is created with 3 candles. Doesn't matter obeno ya green obeno ya black, so long as 3 candles are there. Though mu example yange nalazenga candles zona za green, but doesn't matter. Okay, so in here you have a low, a high, a lower low, and a higher high. Okay, now we have this small dealing range. You can just ask yourself, okay, let's first finish with a breakup, with a bullish breaker. So that candle that created a high becomes our bullish breaker block. To having that dealing range when price was returning to that breaker block. You can see this BC. BCs or fair value gaps A is a BC. Zino kubanga they are respected when we anticipate the market to move higher. But with this dealing range, in a fair value gap, it remove premium. It is above 50% level. So price traded in there, but it came back to it came back for discount fair value gap in here. So hizo kubanga tulaye breaker nengo labye fair value gap ena yimu discount because it is below 50% level. Twagambinga wetubanga tuli mu bullish structure twagala something from discount. Discount fair value gap, discount breaker block, discount order block, because it took out sell side liquidity in here. So it is a level that was taken by that candle immediately. It was encapsulated candle energy ebise high yayo ne rallying. So it is in discount. So price came back to the fair value gap, order block, a breaker block to the upside. Okay, when we are in a bullish structure, you want to find entries below the 50% levels. We don't want to use the arrays as it premium. Okay, so when price respected that, you're rallying an ekola dealing range akalala. Dealing range took off now with a low and a high. Okay, so price, they are disrespecting that big imbalance. It is in premium. Okay, it is in premium. Price came back kati kino kinadde njogerako nti enefuuka order block yadde nga tulina fair value gap. Now when you look onto this, lwaki afuuka order block? First, to anticipating of the market to be bullish. Next, we are in a bullish structure. A bullish array in discount has been respected to the upside. A swing high has broken. So I'm not anticipating to see price breaking at this down close candle. If it's gonna come, shouldn't go below the mean threshold of that candle. So any array becoming useful in its way when it is in a good place, but webanga teri mu good place, is gonna be useless. Egana kuba teyina makulu, like it's gonna be functionless. So ofuuka functionful erina okuba nga eri in the anticipation that you have for price to be doing. Okay, so if you anticipate price to be bullish, then these arrays should be respected. We have that error nga human. Yes, we make mistakes, and you're also gonna make mistakes. So sorry, price immediately came back to that order block with this candle in here, so to travel down a fair value gap, but in the structure already moving at the upside. Okay, so it came back immediately to that to now fair value gap there. So price rallies came back, but look on the close of this candle above the 50% level, just wicked through for my entries below the discount. That was fully disrespected. Okay, so when I zoom in here, still on the assembling range, we now volume imbalance one in. So price kayadda ne trading there tiyakona order block again. That was done for the order block. Price pushing the price higher, return to the 50% below the 50% level, to the volume imbalance there, and to the OTE level there. Okay, the wicks do the damage, the body tell the stories. You can see that 50% level, price no candle closed below that. This one hit it nicely, wicked through, price rallies. This is respected to the upside because we are bullish. We don't want to see this respected. Immediately made an inversion fair value gap. For the inversion fair value gap, we shall also see that later in the series. Okay, let us have this last one, a daily chart. So each candle closed in here, it is a daily candle. Okay, so we have here these lows and that low. So price created here an inversion favor, a volume imbalance, trades there, rallies, creates what? A gap. This is a real gap, telling in. Okay, so price when we are creating new highs at one old high, so it is really hard for us to anticipate the reversal. Then we got the reversal. That could be the day you could want to be long, stopped out, you wait, you really saw that price is gonna come back to these imbalances, and it did. It dropped, created a fair value gap in here, tried to come to that fair value gap, just created relative equal highs. Okay, it drops. We have got what? A breaking structure, traded back into that. Price really took some days into the downtrend. Here we saw that low. Then later we came back to those relative equal highs. Okay, so we took out sell side, came back to the buy side. The market is just doing the same thing regardless of the time frame. Okay, now for the last part in here, liquidity traps and fake breakouts are removed when you stick to your anticipation and wait for it to be there, or let it run without you. Like you may be sitting down on the screens and you anticipate to be bullish, but the only thing you saw, an old high wasn't taken out. You wanna be bearish. Like, sorry, you wanna be bullish. For example, you wanna be bullish. I'll give us an example of a bullish. So you're waiting for price to sweep a low, okay? But the low wasn't swept. Instead, the market made relative equal lows. Okay. Now the anticipation you're having is bullish, is to be bullish, but like there wasn't any array swapped. That's reducing anticipation here because you wanna see some arrays taken or some array swapped. Now weba engineering is liquid at any because relative lows. That means any time it's so good sweeping at those lows. So you must wait. Okay. So that can be liquidity trap. So in my point, if you have something that you're waiting for price to do, don't quickly switch side and just stick to what you anticipate to see from price. If you're gonna be bullish, stick to a bullish setup. You're not taking any mostly ngawafunye narrative and bias from higher time frame. That is just something into a belly of something that's gonna be big. Okay, it can be a down day. Okay, so kubanga bullish trend nofuna down day. Okay, you stick to the bias. Stick to the bias. Yes, you're not gonna be perfect. That's why in here I said you're not trying to be perfect. You're not gonna be perfect. So you're trying to be disciplined in what you have analyzed on a higher time frame, and you're gonna find the entry when it is there. So if it is a fake breakout, the setup may not be there. If the setup was there and you took it, then like that was the model. You took it and that was the result. You take it. Okay. Yes, you don't force the setup to be there. Most times, if you already have the anticipation that you're gonna be bullish, then wait for the bullish setup. Don't quickly switch side. Okay, like this can be really avoidable. Like we all do mistakes, and you're gonna do mistakes. I do mistakes. Yeah. So I'm praised by you, bro, and this is gonna be it for the episode 6. It's kind of long, but just repeat the video and you'll understand at least something from this. Okay, thank you.